Hi everyone, I'm James Harte from littlefishfx.com. Thank you for joining me for this week's Forex Education Hour. In the last few sessions, we've looked mainly at the use of indicators and using indicators to inform us on the movements of price with respect to elements such as volatility, momentum, moving averages and more. And we've looked at how you can use this information to build trading ideas and identify trading opportunities. But in this session, we're going to do away with the indicators and focus purely on the price action itself. As ever, if you have any questions during the presentation, please just write them in the chat function and I'll stop periodically to answer them. So first of all, what do we mean when we say price action? When we focus on price action, we're studying the historical, recent and current movement of price to try and gain an understanding of how the instrument behaves, seeking to identify patterns and sequences that tend to yield specific results with a view then to taking advantage of future instances of these patterns. Now, you might hear the term price action bandied around quite a bit, and I guess for new traders it can be a little confusing because different people can mean different things when they use the term. But generally, price action simply refers to the study of the chart without the use of technical indicators. That's it. So whether we're talking about trend lines and channels, as we've looked at in a previous session, or support and resistance, as we've looked at in the previous session also, chart patterns and candlesticks patterns are just the same. It's all just price action. Now, for some people, trading without the use of several different indicators and the array of information and signals that they provide might seem quite daunting. And indeed, once you start to study price action and the various chart patterns and candlestick patterns that there are, it might start to look even more daunting with such a huge range of various patterns to focus on. Now, price action is actually at the core of my own trading, and I've gone through the process of learning what works for me. And so in this session, we're going to focus on just a few patterns and a few price action setups that really can work well in your trading. And as ever, in these sessions, we're going to keep things quite simple and work on building a solid foundation. Now, the reason for this is that I've been in the position of approaching Forex markets for the first time and delving into the different aspects of technical trading. And I understand how confusing it can get with such a vast amount of information out there and not really knowing where to begin. And one of the biggest hurdles is the amount of time that can be wasted trawling through useless information. So what you're getting in these sessions that we've been doing is really the core of each subject. And the idea is to give you a solid base of understanding of each subject with enough practical information that you can then go away and start trading based on what you've learned. The idea then is that if there are any areas that particularly appeal to you, you can focus in on those and do deeper research and study. And if you are interested in learning about more of the topics that we cover in these sessions, or in learning specific trading strategies, or how to use the different indicators in greater detail, then you should check out the Forex Master Course on the website, which covers all aspects of trading from fundamental and technical analysis through to specific indicator-based strategies. But back to the topic of the session, price action and candlestick patterns. As always, we'll jump right in. So the first structure that we are going to look at is the falling wedge. Now, the falling wedge is a classic chart pattern that remains one of the most popular patterns among price action traders because it can often yield powerful reversals. So the falling wedge is a bullish reversal pattern, and it's formed by converging trend lines, which you'll see here, which show a narrowing range. Now, you'll also notice that the upper trend line, okay, so in this very, very beautifully drawn image that we have, these lines are supposed to indicate price action, and these two lines here, this triangle, indicates the wedge, just to make that clear for you. So you'll notice that the upper trend line actually has a steeper gradient, okay, than the lower trend line. And the reason for this is that buyers are stepping in earlier and earlier each time. So on each descent, each time price sells off within this structure, you can see that buyers are getting in earlier and earlier as sellers are failing to drive price down meaningfully lower. And this is the basis behind the pattern. So as I say, it's used as a bullish reversal pattern. It can be a continuation pattern also, precisely because of this information, because of the information it's giving us on what is happening within the range. So in the same way that we can use indicators to get information on price movement, we can actually gain information just from studying the actual movement of price. So in this scenario, the contracting range shows that momentum is waning, and the flatter gradient of the supporting trend line shows that buyers are stepping in earlier and earlier each time as sellers are failing to drive price meaningfully lower. So this alerts us to the fact that the down move is running out of steam. Okay, we aren't getting these big sustained moves to the downside. Buyers are stepping in earlier and earlier each time. The moves are drying up, and this alerts us to the possibility of a reversal. So we identify a reversal as a breakout of the resistance trend line, of the upper trend line. So this is the move that we play for when we trade this pattern. This is what we're anticipating we're going to see, is that out of this narrowing range, we're going to see an explosive move to the upside. Now, when it comes down to how to trade the pattern, we have two options really. One is the aggressive approach, whereby we could enter long mid-candle as we're actually breaking out of that upper trend line. However, I don't like this approach generally, as it often leads to getting whipsawed on false breakouts. And so I prefer to enter on a candle close, which acts as confirmation of the breakout. Now, the caveat to this is that you need to be a little bit careful with the candle that you actually use, because obviously if the candle is too large, I mean, if we get a candle which closes right up in the middle of the range, well, obviously that compromises our risk reward. So you do have to be a little bit careful with that. But generally, where we get a candle that breaks out of the upper trend line and closes within the lower third, then we can feel confident to go ahead and enter. And our stops go just below the bottom of the structure. So we need to allow enough room below the bottom of the structure here to allow for a potential rollover and a retest of the structure lows before we go higher. Now, once we've entered the pattern, our basic target that we're playing for is a retest of the top of the structure. So whilst this is indeed a bullish reversal pattern and we're looking for a breakout, you will often find that price tends to retest the top of the falling wedge structure. And by the top of the structure, I simply mean the point from which we can attach our upper trend line. So from this swing high in price, when we start to identify the wedge structure, that becomes the top of the structure. The last low before breakout becomes the bottom of the structure. So you will often find that price retests the top of the falling wedge structure only to reverse lower from this point. And this can often catch a lot of traders off guard. So depending on how you trade, you should really look to either exit the trade at this point or move to break even or take some off. But the point is that you really need to be doing something when price retests the top of the structure, because this is generally a key price pivot and is quite instrumental in deciding the near-term direction of price. Now, obviously, there will be occasions when we simply blow out of here and shoot right up through the top of the structure. But for the most part, you'll find usually at the very least that we get some stalling and some sticking from this point. So you can see here that we have quite a decent size structure. So depending on where you are able to enter on the breakout, as I say, you really want to watch out for any candles which are too large and close up too much into the middle of the range. But bearing in mind, we could get in towards the lower end of the structure, then where if the structure is quite large like this, we can generally get quite a good risk reward. So 1.5 to 2 to 1 return on risk. Where we get a much shallower gradient and the pattern isn't as large as this. So obviously this is quite a tall pattern. There's quite a distance between the top of the structure and the bottom of the structure. But let's imagine we have a much flatter pattern and the distance between the top of the structure and the bottom of the structure is a lot shorter. Then obviously the risk reward on that pattern isn't as great. So if you are going to enter on a pattern like that, you're just as well to hold and try to play for a move beyond the structure instead of simply targeting a move up into the top of the structure. So that is the bottom line of the pattern and the basic way in which we can trade it. Now, One key thing to remember with this pattern, and really with all patterns, and this is integral to successful pattern trading, is that you really need to consider the location of your patterns. So I don't just trade every pattern that sets up blindly. So for me, location is the most important aspect when I trade patterns. And generally with falling wedges, my preferred setup is to see a falling wedge at a retest of key support. So the reason for this goes back to what I was saying about how we can use chart patterns to gain information on the market. So once I've highlighted a key support area where I anticipate we will see strong demand drive price back up, I want to look for evidence that a reversal is likely to happen. And knowing that the falling wedge is a bullish reversal pattern, showing waning bearish momentum and building aggression on the buy side, then where I identify a falling wedge pattern into key support, well, this to my mind suggests that the support is likely to hold and yield a reversal. So this is the primary location that I look to identify falling wedge patterns. So here's a great example of what I'm talking about. So this is the euro dollar 60-minute chart. This was actually from December, where we had that really clear support at the 108 area after the December ECB meeting. And we'd had quite a few solid touches of the level prior to this specific price action here. And then you can see that what we actually got was a false break of the level, where we spiked down quickly through the level, reversed, traded back up, traded back down, found support at the level, we traded back up, and then we were obviously just back into this clear range scenario. And so as we started to turn lower from this point, I anticipated that we would get another test of this level. We would get another support move from here, another bounce up. And then you can see as price started to move down towards this level, we actually got quite a clear falling wedge pattern, which really added weight to my bullish bias as we were heading into this level. And you can see that we tested the support level, and the falling wedge pattern yielded a really nice bullish reversal. So this is a great example of where we identify a key support level in the market that we want to monitor for a potential trade, and we use the confluence of a chart pattern to trade the level. So again, we'd enter on the candle close of the breakout, which would be at this point here. And so you can see what I'm saying. Where this candle closes just outside of the upper trend line here, and we're right down into the bottom of this structure range, we have really good risk reward on this pattern trade. And again, as with the very well drawn image that I used to explain the pattern, you can see that this is quite a tall structure. So there's a really good distance from the top of the structure to the bottom. And so where we close just outside of the upper trend line here, we get a really nice risk reward. So our stops go below the low of the structure, and we're aiming for a move back up into the top of the structure. Now, there's an important lesson included in this example, because look at the actual structure of the breakout. You can see that we broke out nicely initially. We got this nice run up into the upper third of the structure. But from this point, we then reversed, traded all the way back down and retested the level at which we broke out of the structure before then reversing higher and trading back up and hitting our target. So this is a great example of the way in which these patterns typically play out, because like I say, there will be some times where the move out of the falling wedge will be an explosive one and a parabolic move straight up into the target. There will be those times. However, for the most part, we tend to see this sort of behavior where price breaks out of the structure, moves up into the middle of the structure, trades back down, retests the breakout zone, and then reverses, trades back up into our target. And again, look what happened when we traded up into our target. We hit the top of the structure and then reverse lower from that point. So when it comes to trading these patterns, you really have to bear this dynamic in mind, because if you move to break even too early, you can get shaken out before price trades the target. Similarly, if you're looking to hold beyond the retest of the top of the structure, this can often mean price coming all the way back on you. Now, this example also highlights another way in which we can actually look to trade these patterns. and that is to trade the retest of the breakout. So as I mentioned, there are many occasions where we break out of the wedge, trade up into the middle of the structure range, reverse, trade back down, retest the breakout zone before finally making that full move up into our target. Now, this retest can either be a retest of the actual descending trend line, depending on the gradient of the trend line and the gradient of the move out of the wedge, or it can be a retest of the actual breakout zone as horizontal support. And there will be times, obviously, where the two are in confluence together. So let's zoom in on that and take a look at it in a bit more detail. Okay, so zooming in on the example here, we can see that after we broke out, price traded back down, retested the horizontal support formed by the breakout zone. It stalled and then reversed higher. So the reason for this, the reason for the retest here and the reason why it holds this level of support goes back to what we discussed in our support and resistance webinar. So we know that this trend line has been a key area of supply where sellers have continued to step in and outweigh buyers, driving price back down. But once this trend line has broken, once this structure has broken, at this point here, we know that demand overwhelmed supply. And we know that there were more buyers than sellers to drive price back up. And so when price trades back down to retest that level, we anticipate that there will still be strong demand in the market at that point. And so generally that's why you'll find that the retest of these breakout zones, even if it's not off the actual trend line, you can see this is quite a distance away from the trend line, but it's retesting the price point at which we got the breakout. And so that's why it holds. And as I say, this is a very frequent dynamic that plays out lots of times, and it offers an alternative way of trading the pattern. Now, the final way in which I trade falling wedges considers market structure and candlesticks. And essentially, what I look to identify is a falling wedge that forms a small double bottom into the low of the structure with a bullish pin bar. And again, these don't occur all the time, but generally I found that where they do occur, they tend to work quite nicely and often front run the actual breakout of the pattern. And obviously the big advantage to entering a trade at this location is that you secure a premium entry with reduced risk because you're much closer to where you need to have your stop positioned. So again, turning back to this example, we can see that we actually have an example of what I'm talking about here. And this is why I chose this example, because it actually encompasses all of the different ways in which I look to trade falling wedges. So you can see that as we traded into the low of the structure, so imagine we're at this price point here, where we traded into the low of the structure and we found this little double bottom, this horizontal support level here into the low of the structure, tested the trend line, and we got that bullish pin bar. So you could have entered long here on a break above the pin bar high, anticipating that we would see a breakout soon. You can actually see from this point, however, that we rolled over and we actually formed yet another double bottom into the low. I got another bullish pin bar at this point here. So this is actually a double bullish pin bar scenario into this low. And then from this point here, you can see that we actually got the breakout. So this is a really great way to look to trade these patterns where you get this price move into the low of the structure. And this really shows the momentum flattening out. So if you think about what we're saying, what this structure is telling us, it's telling us that the bearish momentum is waning, the bullish momentum is building up. And so the moves are getting shorter and shorter, and as we actually start to flatten out into the bottom of the structure and get this sort of double bottom scenario, and then we get the price action signal from a bullish candlestick as well. Well, these are really great telltale signs that we can expect a reversal. Now, this is obviously a little more aggressive because the pattern is actually yet to break out, but where we get into the business end of the pattern like this and the range really starts to converge and we get these bullish reversal candles, generally I found success in trading them like this. And the beauty, as I say, is that you're able to really tighten up your risk because instead of getting in up here and having your stop down here, you're getting in towards the low of the structure and your risk is much tighter, and obviously you're improving your reward on the trade. So that's how I'm looking to trade falling wedge patterns. And obviously the inverse is true for rising wedge patterns. So rising wedge pattern is just the opposite of what we've discussed here. Rising wedge rather is a bearish reversal pattern. So again, considering location, I look for rising wedges to form into key resistance, signaling a likely bearish reversal. And then all of the same entry methods and management methods are valid, but obviously it's just the inverse. So we're selling a breakdown instead of buying a breakout. So you can see here that this is the rising wedge formation. And as I say, it's simply the inverse of the falling wedge. So this is a bearish reversal pattern where you can see we have a rising but contracting range. The upper trend line this time has the flatter gradient, showing that sellers are stepping in earlier and earlier each time as buyers lose momentum. And then we get our bearish breakout. So again, the same entry protocol applies. And this time we have our stop above the top of the structure, and we're targeting a move back down into the bottom of the structure. Now, notably, again, we need to consider the location. And so where we were looking to identify falling wedges into support for a bullish reversal, here we're looking to identify a rising wedge into resistance for a bearish reversal. So that's the wedges. And before we move on to the next price action structure, has anyone got any questions I can answer at this point? Okay, great. I'm glad that's all clear. As I say, if you have any questions, please just write them in the chat function. I'll make sure to stop as we go along. Okay, so the next price action structure we're going to look at is the classic head and shoulders pattern. And this is another key pattern that I monitor the markets for. So some of you are already probably aware of the pattern, but for those of you who aren't, this is the basic price structure of the bearish. One second, let me just answer a question. So, hi James, rising wedge will break down and the inverse is the rule. So basically what we expect, what we anticipate will happen with a rising wedge pattern is that we'll get a bearish reversal, and that with a falling wedge, I forgot which one I said first then. With a rising wedge pattern, we'll get a bearish reversal, and with a falling wedge pattern, we'll get a bullish reversal. Now, obviously, nothing is 100% in the markets, and there are plenty of times when it doesn't play out like that. But generally, when we see these patterns developing, they're the outcomes that we're expecting will happen. So how do you find your entry on the falling wedge example? Let me just go back a couple of slides here, and I'll show you. Yeah, actually, I'll zoom in because it's clearer. So with the falling wedge, what we're always looking to do is enter. Actually, I was saying earlier, I guess that you missed this part, but I don't like to enter mid-candle on the breakout. So with the pattern, we're always looking to enter as we've broken out of the pattern. Now, I like to wait for a candlestick to close outside of the pattern to confirm the breakout. So in this example here, this is the pattern. This is the falling wedge pattern. We've broken out, and you can see this first bullish candle, which closes outside of the upper trend line. This is where I would enter on a falling wedge pattern, and then the stop is below the structure low. Now, as I was also saying earlier, the caveat to this is you need to be a little bit careful about the size of the breakout candle. So if the breakout candle ends up closing somewhere up here and we're right in the middle of the range, that totally compromises our risk reward, and we're obviously much more exposed to a bigger move to the downside. And so if we get a close that is above the lower third of the structure, I will generally just leave it because it just compromises the risk reward too much. So I like to enter on a candle close, and preferably as far to the lower end of the range as possible. So this is a great example where we close just outside of the structure, really tight risk and really great upside return. Okay, so going back to the head and shoulders pattern. So you can clearly see where this pattern derives its name from, and the pattern is outlined with by a left shoulder, a head, a right shoulder, and a neckline. Now, the reason why this pattern tends to work so well is because of the underlying order flow dynamic at play, which demonstrates a clear shift in market sentiment. So if we think about what's happening when we see this pattern set up, imagine that price is coming up here, we're traveling up, we find this high, this initial test of highs, okay? But sellers step back in at this point and drive price lower. We stall out here, trade back up. We move back up through those initial highs. We clear the orders initially eroded and step up to form a new high, which is our head. Sellers step in again, much more aggressive this time, drive price back down. Price is driven back down. We move back into this support formed here, which now becomes the neckline. Buyers step in one last time to try and drive price up. But this time, they're unable to get back as high as this high, and they actually stall out at the point of the initial highs. We then break down and trade back into the neckline and anticipate the breakdown below. So essentially, the head represents a capitulation to the top side, and the neckline represents the key pivot point, which once broken sees, or confirms rather, that demand outweighs supply outweighs demand rather. So this pattern confirms a shift in sentiment. We've had an initial test here which was rebuffed. We've then blown past it to make one last high. Again, we've sold off. We've tried to trade higher, but we failed to even break past the initial high, yet alone get as high as the new high. We turn lower, and this becomes our key price pivot. So we know that once this point is broken, that supply outweighs demand. So again, this is a reversal pattern, a bearish reversal pattern that we're keeping an eye out for. So here's an example of the pattern on the chart. So you can see here exactly what I mean. We trade up, we make an initial high, which is our left shoulder. We get rebuffed, we trade back down. We get our support level here. We trade up past those initial highs. We blow out to the top side. We sell off again, trade back down, retest that support level where buyers are still strong, still keeping price supported. We trade back up, we retest that initial high level, and this is where the sellers are confirmed in the market now, and they take price down. And then at the point that the neckline goes, we know that sellers are in control. So the basic strategy for trading the pattern is actually quite simple. We look to sell a break of the neckline, and our stop goes above the right shoulder, and we're targeting a distance which is equal to the distance between the neckline and the head. So let's say that from the head to the neckline is 100 pips, and we get in here, we're targeting 100 pips to the downside with our stop just above the right shoulder. And obviously you can play for more, you can play for less, it depends on how you manage it. But these are sort of like the basic outlines of how you would look to trade this pattern. So again, in how we actually trade the break of the neckline, I like to wait for candle closes. I don't like to enter mid-candle because you can end up getting whipsawed by a false breakout, which happens quite a lot. Again, remember that until the neckline is actually broken at this point, buyers are still pretty strong at this level. So we can see the price sells off, breaks below the neckline. Our stop is placed above the right shoulder. Our target is clearly marked out. And this equates to the same distance from entry as the distance between the head and the neckline. Now, this example shows quite a strong textbook head and shoulders forming along a horizontal neckline. So you'll see that both the left shoulder and the right shoulder line up equally at the same level. However, this won't always be the case, and you will get times when there is a sloping neckline and you get a left shoulder forming at a different level to the right shoulder because of the sloping neckline. But these are still valid patterns. They can sometimes be a little trickier to trade, but they're still valid patterns. However, this is the classic textbook head and shoulders pattern. When you see this in the charts, when you're flipping through the charts, hopefully this should jump out at you because it's pretty clear. Now, as with the wedge pattern, wherever we identify a structure that we use to trade a breakout, we can then also look to trade a retest of the breakout. In this case, we trade a retest of the neckline. And we'll actually look at an example of this on an inverse head and shoulders formation to give you a look at that structure, because then you'll also get a look at the bullish version of this pattern. So this is exactly the same pattern, it's just the inverse. So the head and shoulders, the classic pattern, is a bearish reversal pattern. The inverse head and shoulders is a bullish reversal pattern. Okay, so here you can see that we have a really neat inverse head and shoulders pattern. So our left shoulder here, a lower low, which gives us our head. We trade back up, retest the neckline, trade back down, hold that level, which gives us a right shoulder. And then you can see that eventually our neckline is broken. So you can see that we break above the neckline as anticipated, trade higher, trade back down, and we actually retest the neckline before trading higher. And you'll notice that we actually retest the neckline a further time here. And this shows just how important a price action pivot this level is. Again, going back to the support and resistance webinar that we did, the shifting order flow dynamic at this level keeps it relevant to the market. So where initially sellers were so strong at this level, driving price lower, once we've broken here, we know that demand is stronger at this point, and so we can see that all of these subsequent tests of the level yield a bullish reversal. Again, as with the breakout of the falling wedge, we need to really factor this situation into how we trade the pattern, because this dynamic of breaking out only to retest the trend line is a really common occurrence. And if you play the breakout, so if you buy the breakout of the neckline and you go to break even too early on the trade, you're really jeopardizing your chances of success, because you end up getting shaken out of a lot of winning trades. And we'll look at this in greater detail in one of the upcoming sessions we'll do, where we'll look at breakout trading. But for the most part, where we're playing a structure like this, where we understand the underlying order flow dynamic that is creating this structure, well, once we've bought a breakout of this level, we really need to allow for retests of this level to act as support to drive price further into our target zone. So moving to break even simply to have the feeling of security, or the false sense of security that comes from going to break even, is really spicing your chances of catching the move that you anticipate. And you can see that this is a good example of that, because if we had eagerly just moved to break even as price had shot out of the neckline here, you know, we'd be up 100 pips or so thinking, right, this is great, it's going to take off. However, it comes back, takes us out before eventually taking off higher. So we really do need to bear this in mind. But as I say, we'll look at that in greater detail in the breakout webinar. So final way in which I look to trade head and shoulders patterns, and again, as we looked at with the falling wedge, how we can start to incorporate candlesticks into our trading of the patterns, we can do the same with the head and shoulders. It's slightly more aggressive, but this is where I look to trade what I anticipate will be the right shoulder. So I trade a potential right shoulder, because generally you'll find with textbook head and shoulders patterns, especially like the ones I've showed you so far, where we have a very horizontal neckline, the left shoulder tends to act as resistance. The right shoulder tends to form at roughly the same level as the left shoulder. And so where I identify a clear left shoulder and a head respecting a neckline, I then wait for price to trade back up into the price level that the left shoulder formed. And then I'll look to trade short from that level, anticipating that it is going to be a right shoulder. Now, the key point again is that I don't just enter short at the level of the left shoulder. Rather, I wait for price action confirmation. And again, the price action signal that I use here, that I tend to use the most, because it's my favorite reversal candlestick, is the pin bar. So the bearish pin bar. So for me to enter this trade, I like to see price trade back up into the level of the left shoulder, and I'll wait until we get that price action signal to act as confirmation that price is likely to reverse from here and to form a right shoulder, completing the head and shoulders pattern. So you can see here we traded up, we stalled out here at our initial high, traded back down, reversed higher here, made our high, sold off and held this level. So imagining we're at this point in time here where I can see that we have this structure in place. We formed a new high, we've held this neckline level. This to me looks like a head and shoulders pattern is likely to set up. And once you start to monitor the charts looking for these patterns, you'll generally find the same thing, that your eyes start to pick up on this price movement and they start to jump out at you. So once price starts turning higher from this point, I'm then monitoring the level of the left shoulder, waiting to get a price action signal. And you can see in this instance here, we traded up, got our bearish pin bar. And so we're able to get short here on the break of the pin bar low. And the beauty here is that, again, we're in with much tighter risk. So our stop goes above the head in this instance, and we're playing for a break of the neckline. So we trade down, test the neckline, and we're still anticipating that we will get the proper breakout that we anticipate we'll get from the head and shoulders pattern. And so we get in at a much better level here. And obviously we then have the choice of adding to the position if we like, as it breaks down through the neckline as we expect. So this is a great example of where I combine candlesticks with price action patterns. I'm highlighting a potential reversal area as indicated by the pattern that I've identified, or by the pattern that I expect is going to set up. And then I'm using a key reversal candle that I know tends to precede reversals when in the right location. So this shows how I gain information on the market and form trading ideas almost at a granular level. Okay, I identify a key structural level that I'm anticipating will see a reversal, so an area of interest where I'm looking to trade. I then identify a reversal pattern, which I know indicates the waning of momentum into that level, a shift in the supply-demand scale. And then finally, I'm using a candlestick, a reversal candlestick, which I know represents an acute shift in market sentiment. And I'm using that to enter as a leading indicator for the bigger reversal that I anticipate will occur. And it's exactly the same with how I enter, using the pin bars in a rising or falling wedge as being a leading indicator of the reversal that I anticipate will happen. Okay, so before we move on to the final section, are there any questions I can answer for you? Okay, great. So this is the last section. Before actually we move on to the last section, here's another great example of a trade that I'm talking about in this respect. So this is a trade that's set up a few days ago. I think this was late last week. This is cable daily chart, and you can see here that we have this really clear head and shoulders pattern on the daily chart. Okay, we traded up, we hit that left shoulder area and got that bearish pin bar. We sold off from that point, and we're now testing the neckline. So this is another really great example of an instance where we can anticipate a head and shoulders pattern developing. So we get in at the right shoulder using this price action signal to confirm what we anticipate will be a head and shoulders pattern. And the beauty is that a lot of times, you know, for a pattern like this, where this is a daily chart and the distance between the right shoulder and the neckline is a good 300 or 400 pips, for most traders, the size of this pattern, so the magnitude of this pattern, is going to negate being able to trade it, because the stop that's required to trade it in the classic way of trading a break of the neckline and having a stop above the right shoulder is just simply too much. 300 or 400 pips for most people is out of the question. So where we're able to get in towards the top of the pattern like this, anticipating a breakdown, well, you can see that we would have caught that move before we even get to the question of whether or not the neckline is going to break. And the beauty is that when we're in at this level here, when we can trade this anticipated right shoulder using our price action as a signal, we don't even need to see a break of the trend line, because we can actually just bank as we hit the trend line. So these are a really great setup to keep an eye out for. And again, as I say, once you get used to spotting these patterns, you'll see that they just tend to jump out at you. And once you get to this point here, where you have your left shoulder and your head in place and you have the clear neckline, then you simply monitor the left shoulder area, looking for that price action signal. So really great setup to keep an eye out for. The price action gets you in early with tight risk and gives you great risk reward. So when it comes to using candlesticks in my trading, as well as the pin bar candlestick, another candlestick or candlestick formation rather, that I look to use in my trading and my analysis is the inside bar. So this is the inside bar formation. It's very basic. We have the presence of the first candle, which we call the mother candle, which is typically quite a large candle, though it doesn't need to be. It all depends on the scale, the proportion of the two candles. And then we have the inside bar here, which is a candle that forms completely within the range of the mother candle. So this formation signals to us there has been a contraction in the market. So we've made an initial directional move to give us our first candle, the mother candle, but then momentum has stalled out and we failed to break in the direction that the mother candle formed, and we formed an inside bar. So if the mother candle is a bullish candle, that means we failed to break the highs and continue higher. If the mother candle is a bearish candle, it means we failed to break the lows and continue lower. So how can this information be of use to us? Again, you know, as I say, with price action and chart patterns, candlestick reading, it all comes back to trying to gain information, to read the market based on what we're looking at without the use of indicators. So how can this information, this contraction in the range, this loss of momentum, be of use to us? Well, essentially, I look to use inside bar formations as an alert to a possible continuation move in the market, so a possible price breakout. So I look for price to make a move based on a breakout from a pattern or a reversal from a level. Then I look for momentum to stall, which gives us the inside bar formation, which I can then use as an entry trigger, anticipating that the initial move is going to continue. So let's look at an example of this. So you can see here, this is sterling yen daily chart. Last year, just before we got that huge sell-off in the sterling yen, you can see that just before we got that sell-off, we had this really clear head and shoulders pattern. And at the point that we broke down through the neckline of the head and shoulders pattern, we got this big bearish bar, but then look what happened. Momentum stalled out. So instead of just exploding to the downside, we got an initial surge through a level which we know is a strongly defended level. We know that the neckline represents a key price point with that shifting order flow dynamic, keeping price propped to the upside as buyers continue to step in. But then we get that surge in supply, which breaks the neckline, price breaks to the downside. We get this big bearish bar, but then momentum stalls out, the ranges contract, and we actually get a series of inside bars here. We actually get 3 inside bars before price then breaks down through the low of the mother candle, and you can see that we just collapse to the downside. So this is a really great setup to look out for, where we get this first impulsive move away from a pattern or away from a level. We get this big momentum bar, then momentum stalls out, and we get this formation of inside bars. This alerts us to compression in the market, and where we see this compression in the market, we can then expect that we're going to get an explosive move. And so we get in as price breaks out below the low of the mother candle with stops just above the inside candle highs. Now, obviously, as I say, this is a bearish example. So if we were breaking out to the upside and we had a bullish candle, we'd be getting in on the break of the highs of the candle. But again, this is a great example of where we can combine candlesticks and patterns to build thorough analysis and create trade ideas. So we identify the head and shoulders pattern, which we know is a bearish pattern. We then break down through the neckline with that big surge of momentum. Momentum stalls out. We get this period of compression in the market, denoted by the formation of these inside bars, before we finally break out and continue lower. So keeping an eye out for these formations, another great way to gain entry to potentially explosive moves in the market. Okay, so that's been quite a dense session. Again, we've covered quite a lot in a short space of time. I really hope, as always, that you found the session useful. Instead of just giving you a broad overview of various chart patterns and candlestick patterns, you know, which you can find elsewhere on the web, I really wanted to give you a working look at how I trade using price action and candlesticks, because hopefully this is more useful to you than just showing you some examples. And again, as I said earlier, the idea with these sessions is to give you a solid foundation in these varied areas that we cover, with practical working knowledge that you can take away and begin implementing. And then if you find the content interesting and appealing, it will spur you to dig deeper into studying further on the subject. So with that in mind, please head to the website, check it out, www.littlefishfx.com. You can check out all of the great free material we've got on there. We've also got the Forex Master Course with 24 in-depth chapters looking at a whole range of different areas of Forex trading. And if you're interested in getting daily trade ideas, you can check those out. We're up over 2,700 pips in 5 months. We just closed down another 450 pips in March. So if you're interested in those, please check them out. And thanks a lot, guys, as always, and I'll catch you next week. Cheers.